Hello guys, welcome to today's training session. And I must tell you that I'm so excited to be here for this training today because of the topic that we are dealing with today, which is entry techniques. Entry techniques. That is, what are the things you need to check out for before you click that buy or sell button? What are the things you need to look out for? But that is very, very important, Then because sometimes your prediction might be right, your analysis might be right. You might know the trend direction. You might know the your point of entry, that is the location to enter. But if your timing of entry, that is when to enter the market, is wrong, you might end up losing your money because the timing of entering the market is very, very important. That is your execution. Your execution is very, very important. Okay. Like, for example, now, I know many of us might have, experienced this scenario that I want to paint now. That maybe you enter a market for either buy or sell. After you have done your analysis, you have done everything and everything is fine. Then you execute, you enter the market for a buy or a sell. And immediately you enter the market, you just discover that the market or the price just begins to run against you. And as soon as your stop loss is taken out, or as soon as you've blown the account or you have blown the account, then you discover that the price now begins to move in the direction that you have already predicted. Not that at that point, not that your analysis is wrong, not that your point of entry is wrong, but it might be that the time of execution, your time of entry might be the one that is wrong. And that is why you see that as soon as you enter, the market begins to run against you. And as soon as you were taken out, the market now begins to move in your direction. So the timing of entering the market is also very, very important as your analysis. In fact, much more important even than your analysis. You understand what I'm saying now? Your analysis, getting the analysis right is very, very good. You must do that. But what I'm saying that getting your entry, your execution right with the right entry techniques or entry strategies is as much as important as your analysis. That is the point that I'm trying to make here. So now, what are the entry techniques that we need to look at, or what are the entry strategies that we want to look at today? There are three major entry strategies that we're going to look at today, and those are the ones that I use. So those are the ones that I'll be looking at today. And number one of them is candle pattern strategy. That is the first one that we're going to look at. So we're going to look at three of them. The first one is candle pattern strategy. Then the second one is chart pattern strategy. And the third one is counter trend line, counter trend break, counter trend line break strategy. So these are the three entry strategies that I usually use. So the candle pattern strategy, the chart pattern strategy, the counter trend line break strategy. So when you are looking at candle pattern strategy, that is when you are at the location at the point of entry, the area of your interest. Like, for example, now maybe the market is making, let me use this. The market is making from your analysis, you discover that you are on a downtrend. It's making lower high, lower low, lower high, lower low, lower high, lower low. Then you now discover that, okay, at this point, I want to enter the market at this particular point. I'm just using this as an example. So if your analysis have told you that, okay, this is the point where you want to sell, in a downtrend, you look for sell opportunity. In an uptrend, you look for buy opportunities. So now this is a downtrend now. Your analysis have shown to you that at this point, you are to sell. Yes, your analysis is correct. You are to sell at this point, fine. But when do you enter? How do you know that it is the right time for you to execute that sell? Everything I've told you, your analysis, the trend direction, the location, everything that you need to look out for, even your confirmation, everything has told you that, okay, at this point, you are to sell. Then you still need an entry strategy for you to be able to click that sell button. Now, and that is what we'll be looking at today. And the first one that I want to talk about now is the candle pattern. So now we have a lot of candle pattern, that we can use. But there are two major ones that I use. Those are the ones that I usually look out for in the market. There are so many of them. We have hammer, we have inverted hammer, we have engulfing, bullish engulfing, we have bearish engulfing. We have inside bar, we have dragonfly, we have doji, we have evening star, morning star, arami, a lot of them, so many of them. Bro, I'm going to be looking at just two in this training, which is the pin bar and engulfing. So now, at this level, when you get to your level, your point of entry or your point of interest, let me call it that way. After you have been making you have been having a swing, low, swing high, swing low, swing, and so on and so forth. Then you have your location where you want to enter the market. Then you will now wait. If you want to use a candle pattern strategy, you wait at that your location. This is my location now. In a downtrend, you look for a resistance. You sell at a resistance. That is, you sell high, you buy low. That is just the principle behind the financial market trading, whether you trade in forex, stock, commodities, and so on and so forth. You buy low, you sell high. You sell at the resistance while you buy at a support, or you sell at a supply while you buy at a demand. So now, let's assume this is our supply or this is our resistance, and I want to sell here. So you now need an entry strategy for you to be able to do this. And what is the strategy that you need to use? So when my price get back to this resistance and I want to sell, I won't click sell immediately as soon as my price gets to this level. I'm not going to sell immediately. So I will look out for candle pattern. I need the candle pattern here that will show to me or that will confirm to me that truly this price is about to go down. On the charts, there are so many information that the chart is giving you that will make you, that you will use to determine your buy or sell, your sell decision. You don't just click buy, you don't just click sell. You understand? So you need to look out for information. So at this point now, at this level now, where my analysis has shown to me to sell. So I will now wait for a candle formation there before I could sell this particular asset. So now, what is the first candle that I always look at here? The first candle that I look at here is, which we're going to look at today, is pin bar. You understand? Call it pin bar. It might be any of this pin bar family. You understand? So call it pin bar. So, and how do I use that? Let's assume this is my candle now. At this level, I want to see something like this. So this is an example of a pin bar, a bearish pin bar. Okay, so you can go and look out for many of them. If you go to Google, you can look for the example of all those candles that I'm talking about. But like the strategy that I use and that I want to teach here now. So the first thing I look out for is pin bar. This pin bar, the information is trying to give you here is that after the price has broken this level and use this place as resistance, okay, move away. After retesting this place, what you need to be looking out for as a resistance is a rejection. With the buyer, buyers are coming. They are coming up here now from what I just draw here now. The buyer are coming up here. So when they get to this level, will they be able to break up and continue to buy, or will the sellers that are waiting here reject the price? Those are the two things. So at this level, you will wait for the reaction of the price. What will the price, what will the market say? What is the reading, the tunes of the market? That you don't just buy. So you need to wait for what the market will say here. So when the price gets to this particular location now, this particular resistance, you need to wait. Okay, will the buyer continue, or will the sellers take over? So when you now see this particular candle pattern, then what this chart is telling you when you say this is that the sellers have taken over. That means the sellers have rejected the price from here. The price have been rejected here and the sellers has taken over. So when you see this particular candle formation at your resistance, then you don't need to waste any time. You know you have to sell, that this market is going to sell. But if you have not seen this and the price is at this resistance, don't say because the price is at the resistance that it's going to be sold. No, it doesn't work that way. You need to wait for a confirmation. And one of the confirmation that you are looking at, you are seeing here, is this pin bar, which is a rejection. Okay, so that is one of the entry strategies that you can use. You understand? And we have many of these pin bar. It might be an hammer, it might be an inverted hammer, it might be a shooting star. Shooting star that I've been trying to remember since. It might be a shooting star. You understand? So we have many of all those pin bars. But either a pin bar, either a shooting star, an hammer, or whatever it is. So what you need to concentrate on is the tail. Does he have a long tail? The moment you see a candle, a bearish candle at a level, at a resistance with a long tail, that shows a rejection. So what you just need to do is wait for this candle to close, then wait for the next bearish candle, to open, then you enter. And there are two ways you can do that. Number one is you can, as soon as this closes, at the opening of the next candle, you can do what? You can jump in. You can jump in at the opening of the next candle like this. You can jump in. Excuse me. So you can jump in at the opening of the next candle, or you can wait for the candle. That is the first way of entry. The second way is you can wait for this candle to retrace back to 50% of this guy, the 50% of this guy, for you to enter just the middle of this guy, to retrace back to the middle of this guy, then before you enter. So either you enter immediately like this, or you wait for the candle to first of all retrace back to 50% of this guy before you enter. So either way, you are good to go. But one thing is, one give you less risk. Like for example, the first one, if you enter from here, because your stop loss will be here. Let me use myself. I'm just trying to say is from here to here, you have lesser number of pips to risk than when you jump in from here. Okay, so it all depends. They are both the same thing. All you need to do is put your stop loss here. If you enter from here as soon as the new candle opens, you enter from here, you are right. And if you wait for it to retrace, for you to reduce your risk, you are also right. But one thing is, there is an advantage and there is also the disadvantage. Like for example, if you want to wait for it to retrace now to reduce your risk before you enter, it might just continue to drop. It might not retrace and it will just continue to drop. And if you enter from here and it begin to retrace, you know, that means you have much risk. What if it retrace and eventually break this place? That means you are risking more when you enter here than when you enter from the 50%. That is just the difference between the two. You understand? So in the nutshell, what I'm just trying to say is, when you get to your resistance, when the price gets to your resistance level, try to wait to see the reaction of what the market will say before you jump in. And the reactions you have to look at, one of the reactions you have to look at is the pin bar. You understand? A candle with a long tail. So when you see it, then you can enter. That is one of the signs that the price will drop. Then another one that I'm going to talk about is the for under the candle pattern strategy is the engulfing. Engulfing. So we have bullish engulfing, we have bearish engulfing. But before I go to that, then this is in the bearish scenario now. Now let us look out for a bullish scenario. So in a bullish scenario, we have price moving up like that, and maybe price come back to your location or your point of entry or your point of interest. So what do? You wait. Okay, you wait for the price. You don't just jump in immediately. Wait for the reaction of the price. And what are you looking for? In this scenario, you are looking for a rejection from here. You are looking for a rejection. Okay, you are looking for a rejection. And what is that rejection called? It's a pin bar, a bullish pin bar. So we have a bearish pin bar and we have a bullish pin bar. So we have a bearish pin bar and we also have a bullish pin bar. So this is a bearish pin bar we have seen here. This is a bullish pin bar. So on your support, you know this, as you are going up the trend, you're having high, low, higher, high, higher, low, higher, high, higher, low, higher, high, higher, low. So at this support on resistance now, so when you see this is a location, this is your point of interest according to your analysis. So now you want to enter. You will not enter until you see a sign that will show you that, okay, it is time for you to enter. That is when the timing of your execution, that, okay, it is now the time for you to click your buy or sell button. So you wait for this. When you see a rejection like this, a pin bar candle, a candle with a long tail, it shows that when the sellers are coming, this is a retracement. When the seller got here, they try to break here, but the buyers that are here, they are much more than the seller, and they are able to do what? They are able to reject the price. So when you see this at a level in the market, at your point of interest in the market, what is telling you is that buyer are taking over. Then what can you do? You just go ahead and do your buy. You understand? Just like what happened here. You can, buy immediately. You can buy immediately as soon as the new candle opens, or you wait for a retracement back to 50% of this candle, back to 50% of this candle before you do what? Before you sell. Before you buy. So either way, you are good to go. Then your stop loss here, and your entry here. So either your entry here or your entry here. So either way. So you can enter immediately, this candle closes here and the new one opens. Then, or you can wait for it to retrace back to 50% before you enter. Then your stop loss here. So that is the first entry candle pattern strategy that I'll be looking at. Then the second one is called an engulfing strategy. Engulfing strategy. So what the engulfing will do is, when you are in a downtrend like this, and you have a point, according to your analysis, you have a point of interest here, that okay, when the market pulls back to this place, I want to believe first and foremost that I'm not talking to a completely beginner here. So you understand when I say a downtrend, you understand when I say an uptrend. I want to believe you know that. If you don't know that, go and watch my video on market structure. That one will give you a better understanding of what I'm talking about. So here, when you're in a downtrend and you have your point of interest here, okay? So for you to buy, to sell from here, you will wait for the market to then tell you that, okay, I am ready to begin my down move. So what do? You wait for this or for something like this. This is a bullish candle, and this will be a bearish candle. That is an engulfing. An engulfing candle is a candle that has a bearish engulfing candle is a candle that have a small bullish candle followed by a big bearish candle. A small bullish candle followed by a big bearish candle. That is, the bigger candle must completely engulf the small one. So in the bearish scenario, this red candle must completely engulf this green candle in body and in wick. Both in body and in wick. You understand what I'm saying? Both in body and the wick. It must completely engulf. So I'm still going to show us all this on the screen, but I want us to have a perfect understanding first before we go to the screen. So this is a perfect example of an engulfing. So at your resistance, you might first of all see a rejection. Fine, even if you don't see any rejection, the moment you see this at your resistance level in a downtrend, okay, what do? You know the price, the market has informed you that it's going south, that it's going in the sell position. So as soon as you see this, can just do what? Jumping into the market as soon as this candle closes, this bearish candle closes, transform and engulfing to show you that it wants to sell. So as an aggressive trader, you can do, there are two ways you can enter this market. The first one is immediately this candle closes, you jump in, okay, and you put your stop loss here, your entry here, your stop loss here. You understand? Then the conservative entry, you might wait for a retest. Okay, you might wait for a retest of this candle. That is a retest of this candle, maybe like something like this. Excuse me. You might wait for something like this to happen. Before you enter. So after a retest of this candle, then as soon as this candle closes, you can jump in. So far, this candle did not close above this bearish engulfing. But the moment it closes above this bearish engulfing, that is invalid. But so far, the close of this candle is not above, is still within this bearish candle. Then you can jump in, then the price will begin to drop. So that is for the bearish engulfing. For the bullish one, your price is going up the trend, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. You have your points of interest according to your analysis. What you do is wait for a bearish candle like this, okay, to form, a bearish candle to form, then a bullish candle. That will completely engulf the bearish. That will completely engulf the bearish, both in body and in wick. It's just the opposite of the bearish, both in body and the wick. Must completely engulf both in the body and the wick. So it must completely engulf the red candle both in body and the wick. So this is engulfing now. So as soon as you see this on your support level, the next thing is you can either wait for a retracement back to this, the middle of this place, then take your buy, or you buy immediately. The difference between the two, as I explained the other time, is your risk. If you enter immediately as soon as this one closes, you are taking more risk than when you allow it to retrace. So from here to here, if you look at this, from here to here, and here to here, you can see that from here to here, you can see that you are taking higher risk than from here to here, where your stop loss is. You understand? So that is just the difference between the two entry. So in a summary, in a downtrend, if you want to enter the market using engulfing strategies, you wait for engulfing to form at this level. You might enter immediately, or you wait for a retrace before you enter. In an uptrend, when you see a bullish engulfing, it's a signal to you that the market will continue to go up right from here. The same thing with pin bar. When you see pin bar here at your resistance, it's an indication that the market will sell. When you see a pin bar at your point of interest, at your support in an uptrend, it's an indication that the price will buy. So that is the first strategy that you need to, that you can use, you know, for your entry. So you don't just enter because your analysis say you should sell, or your analysis say you should buy, then you just jump in. No, you need to wait, you know, for a confirmation, whether you use a candle confirmation or chart pattern confirmation or any other confirmation. So this is one of the confirmation that you see that will determines whether you have to jump in into the market. So the second one we're going to be looking at is a chart pattern. The chart pattern. So if you don't have so much knowledge concerning chart pattern, I've done a video on that. You can go and watch that on my YouTube channel. You see the video there. Just look out for it there. So what the chart pattern is telling us is that we want to use chart pattern strategy. That means after you have done your analysis, just like, you know, here we are talking about entry techniques. So after you have done your analysis and you now have a location where you want to enter, the next thing, like I said earlier, is for you to now look at the entry strategy, for you to have a timing entry. Not that you enter, the market will still not move and it will waste your money, your time before it now begins to move. What is the appropriate time to enter? That is why we are looking at all this. So we've seen candle pattern entry strategy. Then we now want to look at chart pattern entry strategy. And there are two major ones that I'm also going to, you know, teach us in this training. The first one is double top. Double top. Let me even write them here so that you'll be able to, you know, remember them. Let me write. So the two that we did here, let me say EG. We did pin bar and the other one engulfing, whether bullish or bearish. Engulfing. Then for the chart pattern, we'll be looking at double top, bottom, head and shoulder. Or invited head and shoulder. Double top or double bottom, and two, we look at head and shoulder are invited head and shoulder. So those are the two that we'll be looking at here. Now, number one, which is double top and double bottom. How do you use double top? How do you use double bottom? You use double bottom for your entry, you know, when you are in a downtrend. As the price is moving down like this, and you know, according to your analysis, that they are clearly in a downtrend, and you now have a point of interest for you to enter the market, which is your resistance level here. The market has made a down move and it has pulled back to your resistance and you want to enter, you know, that is your point of entry. But now, how do you enter? Using pattern. So as soon as your price gets to this place, to this your point of interest, what do? You now be looking for a pattern. So most of the time when you might need to go down to a lower time frame. Like for example, if this is your 4 hours now, if this is your 4 hour chart. As soon as your 4 hour candle gets to this location, you can now go down to maybe 1 hour or 15 minutes to go and identify or look out for the pattern at this point. I'm not saying at this entire um, level. I mean, at this point, this last candle, if this market is going to drop from here, you will see a pattern at this leg, at this particular leg, in your lower time frame. You will see a pattern there. So all you need to do is go down to the smaller time frame, go and look out for pattern. So if you, on your lower time frame, if you see something like this there, you see something like this, then you should know you are in for a sell. You understand? At this leg, you see a pullback, then the market try to pull up again, and the price was still rejected here, giving you a double top. What double top means is you have one top here, you have a top here, you have another top here, making what? Making double. So when you see something like this on your lower time frame, then you know the market has confirmed for a sell. Then all you need to wait for is a neckline break. This is your neckline break in a double top and double bottom. So you have your double top, you have your neckline break. So just wait for the price to break this neckline. As soon as the price breaks this neckline, then and closes, and the last candle the moment the last candle closes below this line, then you know there is a confirmation for a sell. So now there are two things you can do there. Then you can either jump in immediately and put your stop loss above here, or you wait for a retracement, just like I explained the other time. If you jump in immediately, you understand, that means you're having a larger risk. So from here to here now, from here to here might give you what? Something like, let's say 236 points now. Let's say 236 points or 2.36 pips. But if you enter from here, maybe after a retracement back to this place, it might give you 1.33 or 133 points. So 230, sorry, even like from here now, this is 94 or 0.94. You understand? If you put it from here to like, yes, you're having two point something, 2.03 or 203 points. You understand? So those are the differences. So, but what you need to look out for at this level is double top. The first point, the second point. That is when the price tried to pull up, but it couldn't break this previous high. That is, if the price couldn't break this previous high, that's when you say you have a double top. So the moment the price is rejected from here and it breaks, the SMC traders, they will tell you this point a change of character. They call this point a change of character, but I call it a change of trend. So when you see this double top here, that the price is rejected, it couldn't make new high, and it now come down and break this low here. I call it a change of character, a change of trend, but the SMC trader will call it change of character. So the moment you see this, you know the trend has changed from uptrend that is coming from to downtrend. You understand now? And the same thing happened here. The same thing happened here. You are in an uptrend, higher high, higher low, higher high, higher low. And the price gets to your point of interest, your location where you think is right for you to enter. What do you look out for? If you want to use chart pattern strategy now, what do you look out for? You look out for double bottom. Double top, you look for double top in a downtrend at your resistance, but you look for double bottom in an uptrend and at your support. So this is your support now. What we'll be looking out for here is double bottom. So the moment you see this guy now, this is a double bottom. That is, the price will not make new low. It couldn't break this low. This is a low here now. It couldn't break. No, this is a trend coming down. You want to see them clearly on the charts now very soon. This is a trend coming down like this. Now it's not coming down straight like this. Definitely it should be making a higher high, higher low, higher high, higher low as it's coming down. Something like this. It should be coming like this. So the moment it got to this place, it couldn't make a new low. That means you couldn't make a new low and then pull back, something like this. That means you have double bottom. Okay, then this will be your neckline. So the moment price breaks this neckline and then retests from here, either to here or below. So most times it's good for you to wait for a retest. After a retest, then you can now join the buy. But the moment you see this pattern, a double bottom, a neckline break, then you know the direction of the market has changed. All you need to be looking out for is buy now, no more selling. If you have been selling from here down to this place, you stop your selling from here, then you need to look for a buy. So this is double top, neckline break, double bottom, neckline break. Then around here, you look for your entry. Or as soon as the candle closes above this neckline, you can jump in an aggressive trader, but your stop loss will be down here. That means you are taking an higher risk or more risk. But if you're a conservative trader, you let it pull back, either pull back to this neckline or even pull back below. And you can use your Fibonacci, your Fibonacci to confirm where it's pulling back to. So if it pulls back to 61.8, then you can take it from there. So all you need to do is wait for your chart pattern at this level to form, neckline break, retrace, then you join. So that is all that you need to do from that. Okay, that is all you need to do at that point. So I believe you understand the double top and the double bottom now. And if you don't understand what I'm saying, go and watch my video on chart pattern. It will give you better explanation. Then the second one that I want us to look at is head and shoulder pattern, head and shoulder. It takes the same form, but the only difference between the two of them is just the pattern. As I call this one double top and double bottom. That means for head and shoulder at this level, you might see something like this. When the price gets to this place, let me clean up this one. So for head and shoulder, when the price get to this place, you might pull down like this, then break up this place, pull down again, and then come down again, then come to this place, then before coming down. So at this point, what do you have? At this point, you have a neckline break. Okay, this is your neckline for head and shoulder. This is your left shoulder, your right shoulder, and this is your head. That is why we call it head and shoulder. So the moment you see this chart pattern, you see this pattern at your point of interest or at your location or at a resistance in a downtrend, the moment you see this, then you know you are to sell, that the price has confirmed sell. So either you are using candle pattern or chart pattern, you must wait for something to give you. You don't just buy or sell at this point. You might think this place is going to hold, and it will not. It will just continue to buy. So that is why you need to wait for the reaction on what's going to happen here. Whether you want to see a candle pattern that will tell you the price wants to come down, or you want to wait for a chart pattern. So if you are waiting for a chart pattern, when you see this, this head and shoulder, then you know, okay, you have to sell. Or you see double top here, then you know you have to sell. So when you see this pattern forming, all you need to do is let it break the neckline. Yeah, as soon as this red shoulder, it must form the left shoulder, the head, the right shoulder. So as soon as it forms the right shoulder, then let it break. The moment, because it might not, if it doesn't break this neckline, that means the pattern has not completely formed. You must wait for the pattern to completely form before you can say you want to sell or buy. So not until there is a neckline break here, this pattern has not completely formed. If this pattern, this price gets to this neckline and it pulls back from here, it might end up breaking this place and continue to go up. But as soon as it breaks this neckline, at least 70 to 80% of time, you will know it's going to drop. This price is going to continue dropping. So this is the second pattern that I usually look out for. The first one is top, double top, or head. The second one is head and shoulder. Then in an uptrend, I have this going up, going up, going up. Then after a retracement, at my location here or at this point of entry, I'll be looking for, so in the downtrend, you'll be looking for double top and double bottom, okay? Then in the downtrend, you'll be looking, an uptrend, you'll be looking for inverse head and shoulder or double bottom. And also, if at this point in time, you can see, if you see this pattern here, either double top or double bottom, either double bottom or head and shoulder, inverse head and shoulder, here is an indication that this price wants to pull back from here. You understand? But because I like to trade in the direction of trend, that is why I use this method. Normally, your double bottom or inverse head and shoulder, usually look for it at the bottom of a trend to show that the trend wants to reverse. You understand? So if this trend wants to reverse now from here, you might see double bottom, you might see inverse head and shoulder. But in a trend continuation, you see it here. But in a completely trend reversal, you look out for it here. So if you see it here, you can begin to buy from here. If you don't see it here, then you know the trend is still continuing, because if you have a break of structure here, that means the trend still continues. But if you see a chart pattern here, then you know there might be a reversal that you can buy. So now let's look at the uptrend now. So we have high, low, higher, higher, low, higher, higher, low, higher, higher, low. Then at this point now, you don't just buy immediately. You wait for your chart pattern to form. And all this thing that I'm talking about, is better you look out for them on higher time frame, starting from 4 hours upward. That is where they are more, reliable. If you are looking for chart pattern on 15 minutes, it might not be as reliable as seeing them on higher time frame. So at this point now, if you see your chart pattern here, whether double bottom, or you see, okay, like we have talk about double bottom. Now we are talking about head and shoulder. So if you see your head and shoulder here, that is something like this, inverse head and shoulder. Maybe the price pull up here, come down, pull up again, come down, then now break. So if you see this one anywhere on the chart at a level, then you should know you have to do what. So if you see something like this, then you should know you have to do what, you have to buy. All you need to do is just make sure you wait for a neckline break. This is your left shoulder, this is your head, this is your right shoulder. Just wait. The moment the right shoulder is formed, wait for a neckline break. Waiting for a neckline break is very, very important, but that is when the formation is completed. So as soon as your candle closes above this neckline in a downtrend line. You know, this is your, if you go to lower time frame, this will be a downtrend. So as soon as you see it at the end like this, forming this head and shoulder, then you know you want to continue, that this market will continue to buy. And also, if you see head and shoulder from here, maybe you see this head and shoulder now at this top here, you know the market is making an up move there. But at the top of this trend now, if you see head and shoulder here, then you should know the market is ready to sell. But the selling will not be a counter trend. You understand? That is why I'm using this one as an example, so that you can know that you are to trade in the direction of the trend. So this is my pullback here. From here to here is my retracement. So for me to know this price wants to continue, so if I see a chart pattern here, that is when I will now jump that, okay, my uptrend still continue. So in a nutshell, when you're in a downtrend and your market pull back to a resistance, look out for a chart pattern or a candle pattern before you continue to sell. In an uptrend, where after a pullback, look out for a chart pattern or a candle pattern before you do what? Before you continue to buy. And at the top of the trend, at the top of an uptrend, if you see a chart pattern, either a double top or head and shoulder, you can sell. At the bottom of downtrend, if you see an inverse head and shoulder or double bottom, you can also buy. So that is how we use pattern, chart pattern and candle pattern for entry. So you don't just jump in at a level that, oh, because of the analysis, the market will move from, will drop from here, then you just jump in as soon as the price will get to that place. No, you need to wait for confirmation. If we are talking about waiting for confirmation, these are the confirmation we wait for to say before we jump into the market. So I believe we all understood that, or we all got that. So the last one that I'm going to talk about now is the counter trend line. That is the last strategy I use. Counter trend line. So as you are in the downtrend now, the market is making higher, lower, high, lower, lower, high, lower, low, lower, high, lower, low. So when the market pulls back to your location like this, to your level, what you need to do is just draw a trend line that will touch at least 2 points. You know, normally you're supposed to, this is you're in a downtrend, you draw your trend line from here to here. You understand? That is your downtrend line. But if you now want to draw a counter trend line, that means you draw it against the normal trend line. So this is my counter trend line now. So now with these strategies, what do? You wait for the market, the price to break this counter trend line. You know you are in the downtrend. This is your counter trend line. You wait for the price to break it. As soon as the price break this counter trend line, that is your first confirmation. Then you now wait for it to break this structure that will confirm to you, because sometimes it might break this trend line. If it doesn't break this structure, there is no change of trend. There is no change of character yet, because it might retrace back to this place and give you double bottom here and start to buy again. But as soon as it breaks this structure here, that is a change of trend or change of character. Then you now wait for it to pull back. After a retracement, then you see some bearish movement here, or you use Fibonacci, or you use candle formation here, then you can now begin to sell. But the first thing you need to look out for is, for this counter trend line strategy, let your price break this trend line first. Then after that, let it retest or break the next structure, then let it retest before you sell. The same thing in an uptrend. You draw this in an uptrend, you are expected to draw your trend line like this, but your counter trend line will not come this way. Just try and pick two what? Just try and pick two dots. The moment you are able to connect two dots, then wait for the price Let me use one for just for clarity. So the moment you're able to break, normally it's supposed to be here, but this is where the trend change. So the moment you're able to break this particular trend line from here now, and you're also able to break this structure here to give you a change of trend, then all you just need to do is wait for the price to pull back. Then what you do? The moment it breaks that trend line and break the structure, that means the trend has changed. And just wait for a pullback, then move forecast for a candle formation here, or use the Fibonacci for your 61.8 or 50%. Then you just do what? You just buy from there. So those are the entry strategies that I want us to look at today. So I've talked about candle pattern strategies. When you look out for candle pattern, e.g. pin or engulfing at your location before you enter for buy or sell. I talk about the chart pattern, and I talk about the double top or double bottom and head and shoulder, inverted head and shoulder. That is, you must see all those patterns at this your location before you make your conclude on your buy or sell decision, before you play that buy or sell. Then we talk about counter trend line break, where you make sure the price first of all break the counter trend line, break the structure, then you retrace before you now sell or before you now buy. So now let us go over to the charts while we look at some of those patterns that we have been talking about since, and now we can use them for our entry on the live charts. So like for example now, we look at this AUD USD 4 hours charts. Let's try and identify some of these things that I've talked about. See, currently the first one that I'm going to show you is this. I was on this trade, when the price, dropped up to this place. I was actually sleeping that time. I said, thank God I set my first take profits to this place. Then my second take profits to this particular line here. But unfortunately, I was sleeping. It happens in the night. So when the price got to this place from here to here, actually gave me the first TP here and pulled down to this. But by the time I wake up, the price has come back sharply. The price has come back sharply to this point here. So I was just waiting whether this price will go down again and all that. But unfortunately, it ended up closing with this long tail as this pin bar. So immediately I saw that, I know something is going to happen. I know something is going to happen. But because of that's why psychology is very, very important, that your right state of mind is important when you are trading. But because of that pain, that, no, see, this price has dropped to this place. No, let's see whether it will come back. I refuse to close. If I had known, I would have closed the stuff in profits for me. At least it has given me, I have 3 positions open on this. I put one here, one TP here. Then the remaining 2, I plan to close them on this line. But the one of them has closed in profit here. But the 2, I was hoping that the price will come back down. But unfortunately, the price just closed with this pin bar. So immediately I saw this pin bar, I know this thing is going to reverse. Because not only did I have pin back here, this is like a possible double bottom. This is a low here. It broke this, but it did not close down. Not until it closed, this candle closed below this place. We can't call this place a continuation, but since it did not close below, the price closed below this, so we can call this one a double bottom. So when I saw this, I know this price is going to be, but because of the greed and all that, I didn't close it. I was hoping that it's going to continue down the downward move and all that because of my analysis here. But unfortunately, by the time the next candle will close, it closed bullish. That's when I know that I've lost the stuff. You understand? So what I'm just trying to tell you is that anytime you see something like this is a first low, this is the second low. This is like a double bottom. You should know you're going to have a reversal. You know, this is a downtrend. You remember what I was teaching earlier. This is a downtrend. Now getting to this place, we have a point here, we have another point. It couldn't break lower. Then that's not the only thing. We also have a rejection candle, which is a pin bar. So this is an indication, all indication that this price is going to reverse from here. And what do you have? This is a double bottom line. This is your neckline break. What happens? The price breaks this place, pull back, then it continues to move. So this is a clearly example of a double bottom in a downtrend. If you understand, then this is a clear example of a pin bar in a downtrend. Okay, and now after we have a downtrend, what do you have here? We have an engulfing here, a bullish engulfing. Is an indication that the price will continue to move higher. So when you see all this together, then it gives you an information that you can enter the market, that the price is going in your direction. So this at the downtrend, I saw double bottom. Here I have a change of trend or a change of character, because the price breaks this previous structure, retest. Then from here now, even if we didn't enter here, this is the first entry. With this pin bar is the first entry to this place. Then this is the second entry here. After the neckline is broken, this is your second entry, upward. So when you see this in the downtrend, then you should know it's an indication for you to, this is a double bottom for you to buy. Then when you also see a pin bar, it's an indication for you to do the same thing. You understand? Then let's go and look out for more. This is double top now. If you look at this price is moving in an uptrend here. But all of a sudden, it gets to this level here. And the price begins to do what? Begin to pull down. But before they change the direction, what do you see? You see a double top from here. If you go to 1 hour, you will see it clearly. So when you see this double top here, it's an indication that the price wants to change direction. You can see this is double top and this is neckline. So as soon as this neckline breaks, what do you have? The change of trend, and you can see the way the price has been moving down. So when anywhere you see this, especially on the higher time frame, then you should know the trend is about to change. So if it breaks the trend line, this is your double top, this is your neckline. Breaks the trend line and closes, then wait for it to retrace. But in a situation whereby it's not going to retrace, you will have known that this is where your lower time frame comes to play. If it's not going to retrace, you can go to lower time frame to see what is happening at this particular neckline. If it's not going to retrace, you will know, so that you can. But the most important thing is it must complete the formation by breaking the neckline. So that is the second one. Let's see whether we can see head and shoulder. So what we have there is an inverse head and shoulder. You can see this is a level. You understand? I have a counter trend line here, but it fake out the counter trend line, not close below. If you look at it on that time frame, because I know when this happened, that's why I'm telling that. So when they got to this place, it gave me left shoulder here, the head, and the right shoulder. This is my neckline. And you can see as soon as it breaks the neckline, what did you see? Breaks the neckline, it retested, then continue to move with an engulfing. And this is a perfect example of an engulfing. You understand? At this level, you have a small candle, you have a bigger candle that completely engulf this. So after that, what do you see? You begin to see the stuff moving up. So we have seen an engulfing, how it works from here. We've seen inverse head and shoulder. This is another engulfing too. So when the price was coming down here, with this small one, but this is not a complete engulf. This one did not completely engulf this, but this is still an engulf, but this is a perfect example of an engulfing. So the small candle, the bigger candle, completely engulf this, and the price begins to move. So when you see this at a level, don't joke with it. It's going to move in the direction of that engulf. This is a bullish engulfing. So you can say this is also a bearish engulfing, but this one is not at the level. But if you want to join it together with this, you can say you have a double top here. The price is in the downtrend. This is the perfect example of the one I gave earlier. You have a double top, okay? You have a neckline break, it breaks it, then you draw it very well. Double top, neckline break, and it retested. What did you see? A sell. So when you see this formation now, double top, neckline break, it retests, then you see a drop. Then for it to turn again, give you another pattern, head and shoulder. So those are the things that you need to be looking out for in the market. Look out for your pattern, you look out for your candle pattern, you look out for your chart pattern. And also, if you look at this place now, this is a typical example of counter trend line. We talk about candle pattern, talk about chart pattern, and talk about counter trend line. This is how to use your counter trend line. This is in the downtrend right now. Now the market is doing what? Retracing. So for you to know whether this market now will continue after the retracement to continue to sell, you draw your counter trend line. We are in a downtrend, but it's retracing now. So you draw your counter trend line to make sure you have to at least 2 or 3 points, so at least 2 points. So the moment you're able to get it at least 2 points, you use it to draw your counter trend line. The moment you draw it just the way I draw it now, then you wait for the price to break this counter trend line. You can see that here the price did not break it, it touched it here. Then even from this point, you can see that even from this point, the price touched that trend line, but did not break it, so it moves up here. But after that, it breaks it. So since it has broken it now, we now need to wait for it to also break this structure here. We need to wait for it to break this structure. If the price is unable to break this structure, then there is nothing we can do than for us to do what? For us to wait. You understand? So since it did not break this kind of trend, this structure, yes, it break the counter. It has broken the counter trend line, but it did not break the structure. Remember, I told you the structure must be broken. Then after that, you wait for a retracement. But now, the structure was not broken, but the counter trend line was broken. So to me, that is not a good confirmation. There is no confirmation for sell yet. Because now at this point now, this has formed a double bottom in an uptrend. Remember, go and look out, you can rewind this video and look out. Check my explanation. This is an uptrend now, but now it has formed a double bottom here now. It broke the counter trend line, fine, but it did not break this. But with this, it has formed another double bottom, which means this is not selling yet. Assuming this structure was broken to the lower side now, so okay, this is going to sell, but this cannot sell now. This is a live chart that we are looking at now. This is AUD USD live chart. So at this day now, this particular pair is not going to sell. It's still going to continue the buy. Not only that, it couldn't break this structure. At the close of this 4-hour candle, you can see what it gave us. It gave us a pin bar. This pin bar is an indication, is a candle, pattern that has informed us that this price will continue to buy. It's not going to sell. It couldn't break this structure, and it closed with a pin bar. It's an indication that this is not going to sell, that this is going to buy. This has given us a double bottom. Not only that it gave us a double bottom, it gave us another the candle confirmation of pin bar. So this is an indication that this is going to do what? That this is going to buy and not sell. So that is how you use your entry. Then you use your entry strategy to get a good entry, not just to click a buy or sell button. So I believe I've been able to give you a good explanation concerning all these entry strategies. Talk about, and also been talking about so far the candle strategy, the chart pattern strategy, the counter trend line strategy. So if you still have any question, please don't hesitate to let me know.